Hi, this is Matt with ORATS, and today we'll be looking at earnings plays with earnings coming out this week in many stocks and next week. We'll be looking at the core earnings report. ORATS makes this available either by email or by FTP. I have uploaded the latest one into Excel and used the filtering function to isolate the stocks with earnings coming out this week with the average option volume greater than 400 per day and with price between 20 and 100. And what we'll be looking at is the absolute earnings move by average history. So how much it's moved on earnings as a percent, and compare that to what is implied in the market. So for example, in order to come up with an implied earnings move, we assume where the stock implied volatility might fall to after earnings and solve for what the stock would need to move at in a percentage basis on the day of earnings in order to make that implied volatility a fair volatility. So I've done this, and I've done a divisor with the absolute earnings move divided by the implied move. It's pretty close for ADTN, 93%, but ASML, the absolute earnings move of 3.48 divided by what's implied in the market, it's implying nearly a 6% move in one reading. That's 57% only of that amount. So that would be an overvalued situation, whereas I have Pepsi at 145 is an undervalued situation. It usually moves at 3.22% on earnings. Implied in the market's only 2.22. So let's look at these two stocks a little bit more carefully in the dashboard product, the ORATS dashboard. And I have Pepsi pulled up here. So the bottom table shows the history of earnings over the last 7 earnings. Pepsi usually, or all the time here, announces before the open, and again it's going to announce before the open on the 12th, and it usually moves down 3% on the day of and down 0.6% the day after. We're concerned about the day of move. The average is about 3%. So if we think it's going to move at as we saw before, 3.22%, we could use this calculation parameters up here. Where do we think the volatility is going to fall to in October? Well, we, as a rule of thumb, use between about 90 days. So if we look at the interpolated 90-day average is 23.11, and we add a 3% earnings move onto that, that's a 26.83 fair volatility. And what we do is we compare that fair volatility to what's implied in the market. So you can see that it's slightly over the 25.5 in the market, and we would consider Pepsi, the front month volatility, a buy here. So let's look at the other stock being ASML. ASML we think is overvalued, ASML. And so we'll do the same analysis. We'll look at its history. It usually announces before the open. It is announcing before the open on the 12th, and before on the 13th of July it moved down 0.58%, and you can see it moved down 0.678% here, 7.5%, 5% up, 222. So we're going to have an average earnings move of about 4%. So again, if we look at the 90-day interpolated, if it probably will fall to 46.85%, and then we add a 4% earnings move, that's only 48.81%. Well, let's see what that, you could then type in here, like 10% move. That's higher than the 67 is higher than the 62, so a 10% move we would lose money if we were to sell volatility. A 9% move is pretty close. An 8% move is probably going to be below, so we're kind of in essence solving here. So 8.5 is pretty close. 8.6 is right about there. So it has to move at 8.6% in order to make, and if it falls to 46.85 in order to make this October a fair volatility. So just reviewing, we took the core earnings report from ORATS, we uploaded into Excel, we filtered down to stocks that were reporting next week, we did some price filtering, we did some average 20-day option volume filtering, and we came down to just a few stocks here, and then we looked at what the percentage was when we divided the absolute earnings move over history divided by what is implied in the front month, and we identified a couple stocks that were over and undervalued. Pepsi was undervalued and ASML was overvalued. Then we went to the dashboard and we did some more thorough analysis looking at history, plugging in some numbers to see what would need to happen in order for the fair volatility, what's implied in the market, to occur. And we were pretty certain that, according to our analysis, that indeed ASML looks like a undervalued or overvalued situation, it needs to move higher than it normally moves, and Pepsi is an undervalued situation, it's implied at less than it normally moves. So good luck with earnings this year, and we'll talk soon.